All right, welcome to this explainer. Today, we're tracking a massive, high-stakes global cash rotation that's currently acting as the main engine driving world markets. We're seeing some truly fascinating shifts in where capital is moving right now, and honestly, understanding these undercurrents is absolutely vital for making sense of the broader financial landscape.
So, with global equity markets maintaining this remarkably strong positive trend, we really have to look past those surface-level green numbers. We got to ask ourselves, where exactly is all this smart money rushing to? Because it's not just a rising tide lifting all boats, It's a highly strategic reallocation of capital all across the globe.
Okay, let's dive right in. The absolute core catalyst for this huge movement, it all comes back to a weaker than expected U.S. jobs report. And why does that matter so much? Well, softer employment numbers instantly take a ton of pressure off the Federal Reserve to keep hiking interest rates. And as we all know, when the pressure comes off the Fed, the capital starts moving.
Section 1, U.S. Equities, and the changing of the guard.
Right now, we are seeing a fierce rotation unfold. On one side, investors are basically cashing in their chips. They're taking profits from those booming tech stocks that have dominated the headlines for months. And on the flip side, that newly freed up cash is immediately hunting for safe harbor, locking into stable, cyclical, and value-driven enterprises. It is a classic, textbook pivot from high-flying growth right back to proven value.
And man, this next data point really brings that pivot to life. The Dow Jones Industrial Average has just been dominating the landscape, hitting an all-time historic peak of 52,900 points, closing up 1.14%. I mean, that's not just a slight bump. That is a major milestone, reflecting a profound shift in investor sentiment.
So the crucial question is, what exactly is propelling the Dow to these crazy heights? Well, this record high is being driven by a massive migration of capital straight into sectors like financials, industrials, healthcare, and consumer goods. Investors are clearly prioritizing attractive valuations and the promise of stable, reliable profits over speculative growth.
But if you zoom out to the broader market, it paints a totally contrasting picture. The S&P 500 actually just stayed completely flat, basically caught in a tug of war between those value gains and the big tech drops. Meanwhile, the Nasdaq 100 actually fell 1.61%. We're essentially watching investors ruthlessly lock in their profits from previously red-hot AI and semiconductor stocks.
Looking ahead, this divergence is probably going to deepen. As U.S. economic data slows down, analysts are pointing out some serious contrasting forecasts. The Dow and the Russell 2000 are actually showing signs of losing their current strength, with analysts flagging a potential 2 to 3% correction risk. On the flip side, though, expectations are super high for the S&P 500 and the Nasdaq 100. As cash flow spreads out, those indices are anticipated to eventually surge back even stronger.
Section 2, Europe, reaching new peaks. Now, crossing the Atlantic, that global optimism absolutely does not fade. We are seeing a wave of green just sweeping across Western Europe's top performers. Broad market indicators like the Stocks Europe 600 and the Stocks Europe 50 aren't just doing well, they are hitting absolute record-breaking summits.
To really put this into perspective, let's look at some of the heavyweights. Germany's DAX has rocketed a massive 17.85% strictly from its March lows this year. Think about that. Meanwhile, the UK's FTSE 100 surged over 2.45% in literally just the last 2 trading sessions. That is a very clear, very sudden strengthening.
So, what's behind this European dominance? It's being fueled by 3 rapid-fire catalysts. First, we've got growing expectations of a softer, less hawkish stance from both the US Fed and the European Central Bank. Second, cooling oil prices are actively taking the pressure off inflation. And third, strong regional PMIs are proving that business activity is actively expanding across the continent. It's pretty much a perfect storm of positive indicators.
Section 3, Asia, and a fragile tech recovery. Finally, as we follow the money over to Asia, the narrative shifts once again. We're seeing a unified positive start, flashing green across the board, backed by improved June PMIs that signal genuine economic improvement in places like China, Japan, and other regional economies. But here's the fascinating part. The momentum here is surprisingly being led by the exact same technology sector that the Americans are currently selling off.
South Korea's Kospi is absolutely leading this regional charge with an outsized 5.85% jump. According to analysis, this is being driven directly by a rapid recovery in their chip and semiconductor sectors. Over in Japan, the Nikkei 225 also added a solid 1.48%, totally participating in this regional upswing.
But here is the stark plot twist from our source analysis. Despite all this immediate green on the screens in Asia, the analyst notes, and I quote, "I maintain the view these indices will fall in the near future with a deep correction." Wow, that is a seriously bold counter-narrative to the data we're seeing right now. And they aren't forecasting this impending deep correction out of nowhere. The analysis points straight to 2 things: highly stretched valuations in these markets, coupled with fundamental structural changes that have permanently altered the market's foundation. It's a great reminder that a sudden surge doesn't always guarantee long-term stability, right? So as we step back and track this whole high-stakes rotation of cash, moving from American value stocks to record-breaking European peaks, to this fragile Asian tech recovery, we're left with one really critical question. As these massive global undercurrents reshape the financial landscape right before our eyes, is your portfolio positioned for the shift, or are you waiting for the shock? Thanks for joining me for this explainer, and definitely keep your eyes on the data.